Good morning and welcome to this Wednesday, August the 4th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we've got futures which were up overnight, turning just a little bit to the downside. Just checked a couple of seconds ago. Looked like the Dow Jones set to open about 0.4% lower. The S&P 500 set to drop about 1/3% at the open. And the Qs, the QQQ, which tracks the NASDAQ 100, set to open about 0.1%. So on a relative basis, NASDAQ looks like it's a little bit stronger, but we have reversed. Looks like we are going to open a bit lower. Earnings continue to pour in, most of them very strong relative to what was expected. But still, we've got issues that we're going to have to deal with. And most of it is just, we're in the middle of the summer and we tend to have choppy action. We're not getting a whole lot of help in terms of the 10-year Treasury yield. That money is not rotating from Treasuries to equities. It's going the other way. So that's, maybe putting just a little bit of a drag. I think the market would be a lot higher if we could get the 10-year Treasury yield to continue drifting lower. But for now, that's a problem. Let's go ahead and quickly move over to Earnings Beats. For those of you who are new to Earnings Beats, just want to make sure you're aware we do have a free Earnings Beats Digest newsletter. From time to time, we give out some nice little tidbits of things that we do at Earnings Beats. This morning is one of those days. We actually put a link in for our Earnings Beats Digest subscribers to download our August seasonality chart list. And I'll tell you, I was looking at some of the stocks on this list, and sometimes I look at them, I'm like, okay, these stocks don't look very good technically. They may historically be pretty good, but technically they're not looking great. August, actually, there are several where we're getting breakouts just as they're going into a month where we're historically strong. So many of these stocks we're seeing technicals and fundamentals and seasonality, everything kind of coming together. Which could make for a very interesting month of August. But anyhow, we put a link in for all of our Earnings Beats Digest subscribers, so you can check out that August seasonality chart list. It comprises 20 stocks. At the beginning of every month, we issue a report to our members, just letting them know that here are 20 stocks that tend to love this month. So for this past weekend, the report I sent out was for August. And so 20 of the stocks sent out. And again, in this morning's EB Digest, we provided a link and password for our members so that you could go in and take a look at those 20 stocks. I do a real quick annotation of the 20 charts, just looking for what kind of catches my eye as a key support level, so that in the event the market does sell off like it does a lot of times in August, maybe some of these stocks that are strong August performers, maybe we'll pull back and hit some key support levels. Anyhow, put that in there. Just wanted to let you know, if you are new to us, we'd love to have you as part of this digest. It's a 3 times a week newsletter. It's completely free, no credit card required. You can unsubscribe at any time. Mostly deals with relative strength and earnings, but really anything that kind of strikes my fancy, anything that looks interesting, I try to pass along. All right, let's move on. Take a look at what transpired yesterday in the market. So for Tuesday, August the 3rd, the Dow Jones Industrial Average actually made up much of the loss we saw from that intraday high back on Monday when we got up to a new all-time high record. We got back close to that high again yesterday, closed at 35,116.40. That was just below the all-time closing high, so we still got a little bit of work to do there, but it was nice to see that reversal. But now we've got futures back down 0.4% on the Dow, which is going to be roughly 100, 140, 150 points, something like that. So that's what we're looking at the open. The S&P 500 yesterday went right up to its all-time high, closing at 44.23. The NASDAQ a little shy of its all-time high, but it did reverse off of its 20-day moving average, rising 80 points, or about a little more than 0.5%. Mid caps, big reversal after being down on the day. Small caps, same thing. Both holding on to key moving averages. We are seeing PPOs on both of those indices moving up, trying to get back through the center line. You can see the mid caps doing a little bit better job, actually climbing slightly above that 0 line, and small caps still got a little bit of work to do there. overall, I'm seeing I'm seeing either trending higher, as you can see on the Dow, S&P, and NASDAQ, or sideways consolidating, which is what we've been doing with the mid caps and small caps. So nothing really bad. Looking at the sectors, energy back on top yesterday. We were rolling over at that 20-day moving average, got another big boost yesterday, though, on increasing volume. So big question is, can we get back through that 20-day? We need to. I'm watching this one because if we do go back down one more time, watch 46, key price support, and that goes all the way back into April, that price support around 46. But also, if we go back to 46, you'll see lower prices here and higher PPO, positive divergence. So that's one scenario. The other scenario is we just go back up above the 20-day. So I would be waiting. I don't know that I'd be jumping into energy at this particular moment, right up against the 20-day. But if we can get back through the 20-day, that could give you a fairly solid reward to risk entry, where I'd be careful if we came back down through the 20. Otherwise, you could hold on to it. Healthcare continues to strengthen. This has been one of the best groups over the past 60 days or so. You can see since that low was set back in early June, been moving straight up. This has been a really strong area of the market. Industrials, not so much. You can see over the last 2 months, we've actually been going down on industrial. So the rotation continues. You don't see it in the S&P 500. You pretty much just see it moving higher. You see the Dow moving higher, the NASDAQ moving higher. But when you start looking at the sectors, energy was leading. Now it's been lagging. Healthcare was lagging. Now it's leading. Industrials were leading. Now they've been lagging. Communication services pretty much leading throughout, but it's had a rough week. And it reversed off of that yesterday. It was the only sector on Tuesday to finish in negative territory. So 10 out of 11 sectors finished higher. Wasn't a huge up day, but there was a lot of breadth. There was a lot of movement to the upside. Finally, another big earnings report. Been trying to mention some of these when they come out, but Gartner Group reported some very strong numbers, beating top and bottom line. Huge move up. This one, fortunately, happens to be on one of our portfolios, but IT has been a great performer heading into earnings. And then with earnings, that's another very strong candle. So the stock looking very good. Moving on to the 10-year Treasury yield this morning. Let's get an update here. I didn't go pull the economic reports, so bear with me. I'm going to go ahead and pull those up now and just see. This is not a big week for economic reports. We've got the non-farm payrolls coming out on Friday, and I know we've got ADP that came out this morning, and so I'm going to give you those numbers. ADP, and now sometimes the ADP number can be misleading. I've seen plenty of times where the ADP number comes up way short, non-farm payrolls is a big beat, or vice versa. Well, this month for July, ADP employment came in well short of estimates, but it's still solid. I mean, 330,000 new jobs, normally not bad. However, consensus estimate was 700,000, and last month's 692,000 was revised lower to 680,000. So the fact that it's gone down, I think, is maybe spooking some folks, but it also is going to keep a lid on interest rates. So if we're getting moderate to strong growth without inflation, of course, inflation is the wild card right now. A lot of folks believe we're heading into a hyperinflation period. I don't believe that at all. I think this is definitely temporary due to the pandemic, due to all of a sudden the huge increase in demand, the fact that we didn't have the supply because factories were closed last year. Things had just slowed down. I mean, the economy wasn't very strong. And as a result, there wasn't supply. So it's economics 101, very strong demand, supply not where it needed to be, prices shot up. I think that's going to work its way through our system. And then I think we'll go back to a more normal. But I do think the economy is going to be strong going forward. I don't know that, we're going to continue to see it up here at 6.5%, 7%. But I do expect that we're going to continue to have very strong GDP, and that, along with lower interest rates, should bode very well for equity prices. I am growing a little bit more concerned about 2022, only in the sense that we're seeing some companies coming in with great numbers, but they're being punished a bit because their growth rates, even though they're astonishing, are slowing. Well, of course they're slowing. You can't come out of a pandemic with huge growth rates and expect those growth rates to continue. But a stock like Amazon, for instance, and part of it was Amazon's fault. I mean, they're the ones guiding revenues and so forth, but they came up a little short on their revenues. And then the guidance going forward wasn't as good as expected. And as a result, we're seeing some companies that had very, very strong last year's. I mean, Amazon, you might forget, was about 1,600 and it went to 3,500 in a very short period of time. So it's consolidating those gains. And what I'm afraid of it next year is that some of these other stocks that have played catch up this year may struggle next year because they're going to run into the same difficulties that Amazon's running into. Their demand is picking up all of a sudden. And now next year, they're going to have some comps that are going to be hard to beat. And is the market going to be, unforgiving? And so, but I'm looking a little further out into 2022 for that. I think fourth quarter of this year, I'm expecting to be very strong. My prediction beginning of the year on the S&P was 4,700. I think we're going to hit it. And we'll go from there. But anyway, 10-year treasury yield, you can see down another 4 basis points today, getting close to the low we saw a few weeks ago, which was down around 112, I believe, 1.128. So just a little under 1.13. And here we are back at 1.139. So getting pretty close. I'd like to see a double bottom. My gut tells me we're probably going to keep going a little lower and maybe even threaten that 1% level. If this does go down and we break below that low from a couple of weeks ago, that could spook the market. From a seasonality perspective, as I put in our seasonality report to members over the weekend, August 1st through 3rd tends to be okay, tends to be decent for equities. Once we get past the 3rd of August, tend to see a little bit more weakness from the 4th through the 10th. So, and that doesn't mean every year 4th through the 10th is going to be down. It's just tendency. It's just, you might see a batter in baseball has a tendency to have, really good stats against a certain pitcher. Doesn't mean he's going to get up and get a hit. May still strike out. But the tendency, it's worth knowing some of the tendencies in the market, especially if we begin to see certain technical levels give way. Anyhow, 10-year treasury yield down. Let's keep moving. Moving on to talking technically. One impact that the falling yield has is that it's financials and industrials tend to struggle. And so here you've got financials going sideways, struggling since that early June high. So this whole time that we've been seeing the 10-year treasury yield really fall, and it's been falling since the early part of June. It was mostly just sideways consolidation. Now it's trending lower. While it's been trending lower, look at financials. I mean, they're not breaking down, but they're not performing well versus the S&P 500. And you can see that on this chart down here in terms of relative strength on financials. Here's relative strength of industrials. Both of these are plotted versus the S&P 500. So when it's going down, doesn't mean that financials necessarily are going down the whole time. It just means they're underperforming the S&P 500. So you can see we weren't going down the last 6 weeks. We haven't been going down, but because the S&P has been going higher, financials have underperformed. So the relative strength has been going down. If we can find a bottom on the TNX, I think you're going to see this group respond back to the upside. And I think industrial, same thing. Since June, topped, been going down, then we went sideways on a relative basis. We've been struggling. Got to put in a bottom on the 10-year treasury yield for these two sectors to begin to strengthen. So if you're in the banks or you've been in some of the transports, those areas have been hit because of the movement back into treasuries. Speaking of transports, I want to focus a little bit this morning on transports. Because I said recently, it was about a little over a week ago, I was trying to get through the 20-day. I said, hey, you know what? This is a group you want to keep an eye on. I do believe eventually transports are going to come back. This is one of the few areas of the market that I feel really strongly about going forward, that they're going to do well, but their prices haven't been doing well. So it's one of the few areas I think that has pretty good amount of upside if it can just break this downtrend that's been in. So I'm continuing to watch it. I traded it last week, got stopped out. Looking at it again, might get in on a move back through the 20-day. We'll see. But this trend to the downside needs to be monitored for a couple of reasons. Number one, if you look at it on a longer term chart, I think this could be a cup. I mentioned this in a recent show, but huge move up. I mean, transports went up a lot. We were way above the pre-pandemic level. So I think we're just getting a well-deserved rest. It's not like these stocks have to go up all the time. I mean, they need to, we know we have a lot of rotation and so forth. And so this is a period of rotation out of transports. But I think we're going to see the rotation back in. And I got some things I want to show you that I find very interesting about this whole transportation area. But right now we are a little bit below the 20-week moving average. If we go back to that daily chart, we're down below the 20-day moving average. First step is to get back up through the 20. Now, it looks like the PPO is beginning to cooperate. It's been flattening, starting to turn back up again. We had a nice reversal yesterday. Volume picked up. Can we get back through the 20? That's going to be the first step. Here's an interesting seasonality chart that I want you to be aware of, though. This is the transports versus the S&P 500 over the last 10 years. So this is basically the bull market. Look at when transports tend to make their hay. September, October, and November. These 3 months, the S&P the transports has averaged outperforming the S&P 500 by 3.7 percentage points. That's an average. Of the last 10 years, you can see September and November have been up almost every year. October, flatter on a relative basis, up a little bit more than half. But I think you can see that these 3 months coming up, September, October, November, this is when transports generally get moving. And what I found very interesting is over the last 10 years, the average of transports, their performance relative to the S&P 500, of these first 8 months, the only one that's positive is May with 0.1%. All the others are either flat or negative. So it's almost like, and August is almost flat. I mean, we're now moving into August, but this is just another thing to be aware of with transports. If they make a move and they start to turn their chart around, look at what they've got coming up in terms of seasonality. All right. So one way to play the transports, obviously, you can get in individual stocks, and I'll talk about some of those in just a second. But one way to play it would be with the IYT. I mentioned this also when I talked about the transports a week or so ago. If you look over the last 9 years, 9 years, the IYT has beaten the S&P 500 every September. And August, it's outperformed slightly in terms of number of months where it's outperformed, but it has outperformed in August by 0.3% over the last 9 years. So you've got August, you got September, October, not so great, and then November. So these next 4 months, maybe not so much August, a little bit in August, but again, this is showing that the IYT, which is an ETF that tracks many of the transports, the big transports, tends to do well. Now, the IYT is a very concentrated ETF. You can have diversified ETFs where, no one company dominates the ETF and it's just in this huge, many hundreds of companies basket kind of an ETF, or you can have a concentrated ETF where a few names really dominate the ETF. And that's what you have with the IYT. The big names that you need to be aware of, there are 5 companies that represent more than 50% of the IYT. And those 5 companies are FedEx, Kansas City Southern, Norfolk Southern, UNP, and UPS. So if we take a look at these stocks, see, there's FedEx. So here's FedEx over the last 10 years. You can see August is okay. September picks up. September's not a good month for the stock market. September, 2.9% average return on FDX over the last 10 years. And then look at October and November picking up. I mean, this is when you want to be in FDX. FDX is the largest holding in the IYT. Next up, KSU. KSU, there's the last 5 years. You can see November very strong. Last 10 years, August 1.1%, September 1.3, October down a little, November bounces back. And you can see on a percentage basis, these aren't the greatest months. This one's okay, but it actually tends to do better earlier in the year. So I would just say KSU is more neutral, maybe even a slight drag. Next up, another railroad, Norfolk Southern. Go back the last 10 years, a little bit better action on Norfolk Southern. So August, September, pretty good months. October, not so much. November, a huge month, averaging 7.2% the month of November. So we got some really good action going into the last 5 months of the year, 5 months of the year on NSC. Next up, Union Pacific, UNP. 10 years, August, flat, maybe a little bit of gain. Look at September, 3.1%. Then after a weak October, get back into November, very, very strong. If you add these 4 months together, August through November, you've got pretty good action, UNP as well. And then finally, UPS. So UPS, you can see in August, pretty strong, 2.1%. Averages going up 70% of August. September, 1%, 78%. October, pretty flat, and it's kind of more of a coin toss. And then November. I mean, one thing you'll notice is November is strong for all of these stocks. Transports love it when we get to the month of November, but leading up to it, we're pretty strong as well. So now this leads me to say, okay, well, let's look at the chart. Well, we looked at transports. How about FedEx? Well, FedEx is at a level where I think it needs to turn. And we had a nice reversal yesterday. It tried to bounce right off of this support level. So after moving up here, you can see we hit the support in April twice before moving up and breaking out. Came back down to 280 in June. And now here we are testing this level again, trying to reverse back to the upside. I want to see FedEx get back up above its 20. It's got some work to do. If there's one positive, though, notice you see a lot of these moves to the downside where you've either got long tails or you've got hollow candlesticks. So the news has been, not so great for FedEx. And so we've been seeing a lot of movement to the downside, but we've been closing pretty strong. And as a result, while we were coming down, the AD line was going up. So it looks to me like maybe FedEx is being accumulated on this pullback. So this kind of fits in to the story, if you will. How about these others? How about Kansas City Southern? So you got KSU, which has been trending lower. AD line does not look very good. And this is the one that seasonally was not great. So if there's one weak link in the group, I would say this is probably it. I also would point out that we are down near a gap support level where we've now held 3 times. So maybe we'll get a breakout above that 20-day, but I'd like to see it first. I don't want to assume it's going to happen. Then we've got NSC, which is Norfolk Southern. Norfolk Southern also downtrending. Also, its AD line not looking great. Railroads haven't been very strong if you've been paying any attention. But like KSU, you can see we've got pretty decent support right in here where we've been holding for the past few weeks. I'd like to see that continue. And then we just need to break this downtrend. And it's got some work to do with the AD line. Relative strength, not the best for sure. Versus the S&P, it's been horrible, mostly because look at the railroads. I mean, if you're a railroad right now and you're outperforming the S&P 500, kudos, because the group has been really struggling versus the S&P. This has been one of the primary reasons why transports have been lagging so badly. And as I've said recently, if there's something that keeps me up at night, I'm very bullish about the market. But if there's 2 things that keep me up at night. One is the falling treasury yields, which are falling again today, and the falling transports. And with futures down, we may be seeing another drop in transports today. We'll have to see. But those are a couple things that bother me with the market right now. All right, UNP. UNP has actually held up much better in terms of how it's performed versus its railroad peers. So you can see it actually going up versus railroads the last few months. And instead of a big downtrend, yeah, it's going lower, but it's essentially been holding on to this 215 area for the last few months. So I don't see as much movement to the downside, but that AD line's been weak. So all of these railroads look like they've been distributed. That needs to change for the IYT and for transports to come back. And then the final one, UPS. I think UPS and FedEx both are looking pretty good. UPS especially, we've gone down, we've hit this gap support level, which I think is pretty critical. So I'm going to say 189, 190. Watch this level pretty closely on UPS. But UPS, likes the month of August, September, heading into the fall, and hit a key tactical level. AD line looks good. This is one that I definitely think could begin to strengthen from here. Big level to take out as we move higher, going to be that gap down right here. So the bottom of the gap, which was at 198.07, that's going to be a key level getting back through, along with the declining 20-day. So watch those couple of levels. But, waiting and seeing the transports rebound and then coming back and saying, well, transports historically do well, so this is no surprise. What I'm just trying to do is point this out ahead of time. So it's something you can be watching for. This group has not been strong. It continues to be challenged technically. I'm not saying you just want to go all in, but as we get closer to the fourth quarter, this is a group that really tends to outperform, and it is a group that has been getting beaten up. So just want to point it out, do a little work on it here for you. All right, earnings. So earnings, continue to just pour in really strong. I'm going to give you a couple that are that have positive reactions from Wall Street today. So we're going to take a look first at Activision, ATVI, 91 cents versus 76 cents. The market's been beating the stock up. It is coming back up 5.6% to $84, but it's still got a lot of work to do, to get back up technically. So even though it had a good report, even though it's gapping up, it's one I personally would just watch for a while. I would not be interested in trading it. One that I do like, though, and I mentioned this recently, I think in the special software report I sent out to members maybe a week or two ago. This is one that was getting up close. I think this was one that I had put in there. I know it was one I was reviewing, but you can kind of see it. It had been moving up the last few months, getting very close to a key resistance level. This is one of the stocks that does very well, by the way, seasonally. Let me pull up this PAYC for you. And look at the month of August. Since it went public, it has gone up every August. This will be 8 for 8. And the average gain during the month of August, 16.4%. So knowing that, now, of course, you still got to be willing to hold into earnings, but look at the stock up 8% in pre-market today. Came out with their earnings. They were expected to earn 83 cents. It came in with 97 cents. And the stock now up over the 430 level with a clear breakout above these levels. Still got some overall work to do. I think the all-time high was around 470, I believe, 460 or 470 from what I recall. So still got some work to do, but this is one clearly that the market is beginning to price up. Ring Central, RNG. It's been a real laggard for a while. It was a darling in 2020 during the pandemic, but it has been going down. It's starting to show this pattern, maybe a higher high, higher low. We have to put in a higher high. Well, we're getting a start anyway, up $10 over 280, but it's got to get through 310. And if it does that, then it's starting to begin what could be a series of higher highs and higher lows. But Ring reported earnings 32 cents versus 28. Let's see. How about those to the downside? Akamai. Down 5% in pre-market. They beat $1.42 versus $1.39. Stock's been going up 113. This is going to be an interesting level if it opens way down here, because it's going to be below this double bottom. I'd want to see this either come back up immediately off the open, or this could be a signal of a reversal. If we gap down below 114, and then when you see a filled candle with very heavy volume, that to me is a signal of a reversal, this uptrend reversing to a downtrend. The next one, AYX. I think this is another software company. down 9.9% today. It's been in a bear flag, huge bear flagpole. Here's that flag coming out. And now we're going to break down on today's open. This is not good. Again, and barring a big reversal, this looks like the next leg down on AYX. Those were all companies that came out yesterday. Market just opened. We're going to wrap up here in 2 seconds. So now that the market's open, let's do for the three you must see. 3 companies that reported this morning. One was CVS, which reported a really good report, had a really good report, but was down pre-market. 242 versus 207 in earnings. CVS was down 4% pre-market. It is coming back though. So it's down 2.9. It gapped down, trying to hold on to these this double bottom here. Also on the breakout, you should have tremendous support down around 76 if it were to get there. But CVS trying to reverse off that 80 area. So that's one. How about KHC, Kraft Heinz, KHC? They reported 78 cents versus 73 cents. Right now, the market just doesn't care. Here's a stock that's been downtrending, good numbers, and the stock's down another 2%. Maybe we'll reverse, put some kind of a big reversing candle in. Let's see what the weekly chart, see if there's any clues on the weekly chart here. No, it's going down. I mean, the big breakout came on this double top breakout around 35. So the closer it gets to the 50-day and 35, the better I like the reward to risk here on KHC. The last one, how about Royal Caribbean? It's going to be interesting. I didn't even look at this one yet pre-market, but before I pull it up, they were expected to lose $4.26. They lost $5.06. Still, just no end in sight to these losses on many of these cruise lines, airlines, so forth. But Royal Caribbean is down 1.73%, rolled over. Looks like it's probably heading back down to that January low. I know when the positive vaccine news came out, we got this huge move up. Eventually in February, got all the way up to 98, almost $100 a share. And now we've lost 27% off of that high. And, you know, again, and I've talked about airlines and cruise lines a lot over the course of the last year. Even when they were going up, I was not a fan. Just, I don't know, maybe it's the conservative fundamentalist in me. You know, I didn't see how these two areas were going to thrive financially in this environment as long as COVID is overhanging us. And so I just never have really followed these companies close. I don't trade them. I just don't trust them. You know, last week or a couple of weeks ago, we got this big move back up off the bottom, 67 to 80, and then right back down. I mean, I suppose they're great trading vehicles if you can time them because they are very volatile, but I just don't trust them to hold them. I don't know where they go from here, but I wouldn't be surprised to see RCL move back down, test that recent low, maybe go all the way back down to this gap support around 58, 59, something like that. All right, let's get a quick update on the market, then we'll wrap this thing up. All right, so futures said we were going lower. Look at the Dow now down 200. So on a relative basis, the Dow getting hit much harder. The S&P down 1/3 of 1%. NASDAQ down barely anything now, almost essentially flat. NASDAQ 100 is flat, broken into positive territory. And we're seeing a little lagging performance in small caps, mid caps to get things started. So market a little rough today. At least at the open, we'll see how we do throughout the day. But just keep in mind, 10-year Treasury yield going down. August and September can be choppy. I just think more than anything, we just need to lower our expectations for this secular bull market right now. If we're going to pull back, I feel very strongly we're going up in the fourth quarter. If we're going to pull back, or if we're going to have choppy action, I think now is the time we're going to get it, now through September. I've said on a few occasions, July 17th close to September 26th close. That is the worst time historically for the stock market. And we've come a long way. If we're going to struggle, this is the area. So just keep all of that in mind. Everybody have a great day. Be back tomorrow with Trading Places Live, the recorded version over at Stock Charts TV. So when you go in the stock charts, just click on this link up here at the top at 9 a.m. Eastern. And you can listen to the recorded version of Trading Places Live. Have a great day, everybody. Happy trading.